Welcome to another topic deep dive with ZWEI Wealth. Today on the topic of US dollar hedging, yes or no. My name is Cyril Moser and I'm very happy to have Stefan Meyer here today with me from ZWEI Wealth, and he's responsible for our institutional clients. Welcome, Stefan.
Thank you for having me.
Good to have you. So what's the agenda of today's webinar? We'll take a quick look back about the currency developments generally, and in particular about the US dollar Swiss franc development. Then, of course, we're going to talk about the hedging costs. How are they derived? How high are the hedging costs? And then we're going to take a look whether this was actually worth it over the long and medium term. But before we start, Stefan, there are so many different currency impacts one could talk about. We're not going to talk about all of them. Why don't you tell us a little bit what kind of currency impacts there are and which ones we're actually talking about today?
Yeah, so we're talking about the fact that we buy stocks in different currencies. So for example, Apple and Nestle. Apple is listed in New York, it's traded in dollars. Nestle is listed in Switzerland and traded in Swiss francs. So if we invest in US stocks and in Apple, we have to get US dollar exposure into our portfolio. And is it worthwhile hedging this? That's the topic of today. There is a complex topic around currencies because Apple and Nestle are big companies, global companies. Nestle in particular is a company listed in Swiss francs as a share, but is a global company that makes only 2% of its revenue in Swiss francs. So the dollar, the yen, the euro are much more important for the operations of Nestle. And therefore, Nestle is a basket of currencies as a company that we buy. But there is also a CFO and the Treasury Department at Nestle that is aware of the risks of selling goods in dollars, in euro, and translating everything into their accounts in Swiss francs, into consolidated Swiss franc accounts. And we don't know from the outside what the Treasury of Nestle actually does to hedge currency risks or not hedge them. So that's a complex topic, but not topic of today.
Very good. Yeah, that's very important. So let's take a quick look at this current year, 2025. We're sort of at the end of October. And we're looking at these currency developments. Yeah, at the top, we have two charts. The top chart is basically the US dollar basket, so the US dollar against a basket of other currencies. This is the yen, the Canadian dollar, the euro. It's also including the Swiss franc. And we take a look at that. And then at the lower part, we see the US dollar versus the Swiss franc in particular. And from what I can see, they look very similar, Stefan, yeah?
That's correct if you look at this year. So the dollar has actually lost 10% against this broad basket of currencies and 12% against the Swiss franc. However, if you look at the top graph, the dollar basket, the 10% devaluation of the dollar is the strongest since 1973. So if you go back and look at this chart in a very long-term horizon, then you will see that the dollar has actually not lost as much as this year all the way back to the 70s. For Swiss franc, and we come to that a little bit later, it's much more continuous, the devaluation of the dollar, as it is for many other currencies against the Swiss franc.
Many thanks. And so, of course, this had quite an impact on everything. But we first want to have a quick look. Why did this actually happen? Why do you think the dollar devaluated so much this year?
It's a loss of confidence in the US dollar and also driven, I think, to a large extent by US politics. I think it is obvious from what we've seen since Liberation Day that there is a lot of erratic behavior. There's a lot of things that make it very difficult to really understand and have confidence in the stability of the US dollar the way we had it maybe in the last 10 years. Trump has really changed a lot of things. He introduced tariffs. For some of the countries, he introduced tariff rates of 100%. Then he sometimes withdraws them. He uses them as a bargaining tool. Then they are reintroduced. We, from our Swiss franc Swiss perspective, had to follow the discussions that there were negotiations. Everybody was sort of like hopeful that we could reduce the tariffs that were in the room down to something like 15%. Then there was this infamous phone call of Karin Keller-Sutter with Trump, and suddenly we are faced with 39%. We still don't know if the 39% are going to stay, so we'll still have this uncertainty. So there's a lot of uncertainty. There is geopolitical rivalry of China versus the US, which is more pronounced than it was in the past. It has always been there since the rise of China to a global superpower. Obviously, there's tension, but I think it has gone to a different level and has a more menacing tone now. The US Fed is continuously lowering interest rates. We're down to 3.75 to 4% now in the Fed funds rate. Doesn't really help the currency if the interest rates go down. And then there is, for us, particularly in Switzerland, there's always the topic of Switzerland as a safe haven.
Yeah.
So whenever there is when there's insecurity, there is market turmoil, many investors turn to safe havens, and Swiss franc is certainly one of them.
Yeah. And of course, we felt this impact also on the portfolios that we're tracking. We see here two graphics on the left-hand side, the Swiss franc portfolios. The red line depicts the zero return line. And on the very left, we have the fixed income portfolios. And then as we move to the right, we have the balanced and then the equity portfolios. And we see how the Swiss franc portfolios were struggling. The median return was just over the red line, but just barely. But there were also many portfolios that are in negative territory across the different risk profiles. The picture is very different on the right-hand side, where we see all of the portfolios are above the red line. Even fixed income, balanced equities, all of the portfolios well above the red line, and the median in the 5% area already for fixed income portfolios, 10% for balanced, and then 15 and above for equity portfolios. So of course, investors have felt the pain from this portfolio, from this dollar devaluation. So next, we're going to have a look at a little bit longer. Yeah, we take a longer look back. This is the same charts that we looked at before, but now it's 20 years horizon. And all of a sudden, these two charts do not look the same anymore. Yeah. So what's happened?
What you can see, as you rightly said, is that the dollar has actually gone up 10% over the last 20 years against this broad basket of currencies, but it has lost 40% against the Swiss franc. So there is, if you now go back even further, I mentioned this 1973 loss, which this year's loss was as big as back then. So before this, the 20 years before this graph, the dollar has actually devaluated already a large part, and then sort of was at the bottom around the 0 years from 2005, 6, 7, and then has recovered quite a lot. On the other hand, when you look at the Swiss franc, this continuous devaluation is a feature that goes further back, and it is going further back with all different currencies. So there is no currency that actually appreciated continuously against the Swiss franc in the very long run.
Very good. Thank you very much. So we're going to leave the review part, and we're going to talk about actual hedging costs. So a lot of clients wished maybe they would have hedged the dollar in particular this year, and they're thinking about, oh, should I hedge my dollar exposure now going forward? And first of all, we need to discuss what are the costs of hedging a currency. How does this actually work, Stefan? How can somebody just, have an idea about what it would cost to hedge a currency?
Yeah. In a simplified way, I would say it's the difference between interest rates in two different countries. So if I want to invest my money in a safe form in the US dollar, I can buy money market funds, or I can give my money to a US bank. And the interest rates that I'm getting for making this investment is around 4% at the moment. The banks and the money market managers, they take their cue from the Fed funds rate, which is, as I said before, 3.75 to 4%. And this is sort of what you can get for a safe investment in dollars. In Switzerland, we are down to zero. If you're a big pension fund, I think you're even faced again with negative interest rates that banks actually want to discourage you from giving them large amounts of cash. And so as a normal, let's say, a private investor, you get nothing, you get zero. But as a big investor, you might already be faced again with negative interest rates. And now this difference between the 4 and the 0, these 4% difference, that is baked into so-called forward rates. So if I want to hedge my dollar, I have to sell it forward. And the costs of doing that are the 4% because the forward rate is 4% lower than the spot rate. And if I do this on a continuous basis, simplified, my costs of hedging are always the differences between the short-term rates in the two currencies.
Thank you very much. So in US dollars, that would be, roughly, there are other costs associated with it, and it depends how you dynamically do this or what your rebalancing is, et cetera, et cetera. But as an idea, we're talking about 4%. So one could say, well, as long as I can forecast the currencies, it should be an easy decision whether I hedge the currency or not. But this is a big problem.
It is very difficult. I think the currency markets are probably the most efficient markets, more efficient even than equities, more efficient than bonds, which means that the prices are right in a way. Everybody is doing currency transactions. We have to if we buy foreign goods, if we invest in foreign assets. And therefore, all of the known information, which is transmitted in media, over the internet, all of this information that you could normally use to make a forecast is already baked into current prices. And so therefore, I believe it is extremely difficult, if not impossible, to make short-term forecasts for FX.
Correct. And now, long term, there are a few supporting data that one could use, to make some long term, not forecasts maybe, but an indication.
Exactly. I think from what sort of like empirical research shows, and what also the economic literature shows on FX, is that there is a theory called purchasing power parity. And that one argues that the exchange rate between two countries moves in parallel to the difference in inflation rates. So if you have a basket of goods, tradable goods in the US, and you have a basket of goods in Switzerland that could actually be traded between the countries, economic forces should make these baskets more or less equivalent in price. And therefore, if you have a continuous higher inflation, let's say in the dollar, 4% for argument's sake again, and 0% for Swiss franc, it's actually in the US dollar, it's 3% at the moment, and it's close to zero in Switzerland, then the longer term devaluation of the dollar against the Swiss franc is this differential in inflation rates. So between the 3 and the 0. And what you showed with the long-term graph is pretty much that. So this very, very long-term chart that showed the 40% devaluation over 20 years is more or less this representation between the differential in US inflation and Swiss franc inflation.
Many thanks. So we've derived a little bit what the hedging costs look like. Now we're going to take a look whether this was actually worth it to hedge the US dollar. And we're taking a look at a chart here over 10 years. We have two lines. The green line is the MSCI World in unhedged, in US dollars. And the white line is the MSCI World Swiss franc hedged. Both prices, though, are in Swiss francs. That is important to note. What do we see here, basically? What's happened over the last 10 years?
I think it's an interesting analysis because it shows the first thing we see is that the green line is above the white line, which means that if you would not hedge the investment in the MSCI World, you would simply buy the US dollar share of that ETF, you would have made 150% over the last 10 years. If you would have invested in Swiss francs, if you would have bought the hedged version of the same ETF, you would have made 135.9%. So you would have actually made about 14% more in Swiss francs by buying the dollar and just continuously transferring at the spot rate your investment into Swiss francs. And this actually happened even though the dollar lost 19.5% over the last 10 years versus the Swiss franc. So there was devaluation of the dollar, which you could have avoided, but the cost of avoiding it would have been so high that you would have lost 14% relative instead of just buying the unhedged investment. And I would say the reason for that is a simple phrase, which is there is no free lunch in investing because it costs. And as a private investor, you basically have to go and buy a hedged version. So you have to give the money to iShares, which continually do this for you, but they charge you a cost for doing that. If you're a private investor and you let your bank do the hedging for you, also the bank is going to charge you for that. And so therefore, the costs of hedging is what you really see in the difference in performance.
Yeah. Very good. And we see in the table also over 5 years, the green line, it's not shown on the chart, but the green line would have also been above the white line, not as much, by about 1.5%, but still a better performance through the unhedged version. Of course, over 3 and over 1 year, we know now that the dollar has lost 12% this year. Of course, in hindsight, it would have been, it would have helped to have it hedged this particular year. But as we just said, we cannot forecast the currencies in the short term. And that is really the core assumption that we make here. Now, so it wasn't worth it for an equity portfolio over 10 years, over 5 years. What about bond portfolios? I think here is a nuance that's very important to highlight.
Yes, that's true. I mean, the costs are the same. Hedging is hedging, bonds or equities. But there is a difference from a portfolio perspective because you buy shares, stocks, and bonds for different reasons. You buy bonds for regular constant yield, on one hand, and you buy it for stability. And you buy it for times when there is volatility in equities and they lose in value, that you have a counterbalancing effect in your portfolio. Bonds as an asset are not so volatile. So if you buy money market investments, they have almost no volatility. If you buy 10-year treasuries or 10-year bunds or 10-year Eidgenossen, they are maybe a little bit more volatile, but they're still below 10% in the volatility. Currencies, on the other hand, have a higher volatility. They are somewhere between 10 and 20%, sometimes as high as equity volatility. So if I buy US dollar bonds and I don't hedge them, they actually lose their stability feature, their low volatility feature, because they suddenly get the volatility from the currency. And I don't want that. So irrespective of the costs, there is a portfolio argument for hedging bonds so that they are the low volatile, stable part of the portfolio.
Very good. Thank you very much. So we're actually concluding already from our webinar. We conclude that currency hedges for equity portfolio do not pay off over the long term. Yeah, we would not recommend to currency hedge an equity portfolio. The hedging costs are simply too high over the long term, and we cannot forecast the currencies, certainly not over a short to medium term. They're very unreliable in the short term. Yeah, and bonds, in order for them not to lose the stability function, there is a recommendation to take a look at currency hedges, because that could actually pay off partially or wholly to currency hedge a bond portfolio.
Yeah.
With that, we conclude. Stefan, thank you very much for joining us today for this topic deep dive. I hope this was interesting, and we wish you all a continuous good year of investing. Thank you very much.